We found out late last week that Rivian's next plant, which is going to be built in Georgia, is going to be completed way later than originally anticipated. Got some firm dates around that, and that really puts into question Rivian's balance sheet and cash burn over the next couple of years. I'm going to show today why Rivian has a $10 billion hole in its balance sheet. That's how much money it needs to raise to get to the point where it can build R2 and R3 in Georgia. I'm going to go through all of these numbers. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's go right to the disclosure that we found last week. This is a disclosure that was given to the Department of Energy for Rivian Stanton Springs North, as it is being called. So really big report. I'll put a link to this in the show notes if you want to look at the whole thing. On page 14, there's a nice map of what exactly this facility will look like if you want to look at that. But I want to go to page 16. This is where you start to see project schedule, and what they're breaking this into is 2 phases. We knew this was going to be the case for Rivian. They were going to build phase 1 first. That's going to be about half of the total production capacity, around 200,000 vehicles, and then the full capacity would be about 400,000 vehicles when phase 2 is complete. As management says here, phase 1 will start, and then phase 2 is not going to be completed until 2030. But they did give an outline of phase 1 and what exactly this looks like. That's this table right here. And this is what I think really is going to be critical. Rivian has a lot of explaining to do from a cash perspective based on these numbers. What they're saying is they're not really going to break ground on this plant for almost another 2 years, Q2 2026. Manufacturing validation doesn't begin until 2027, and scale production not until Q4 2028. Now, we know exactly how much trouble Rivian has had scaling its production in Normal, Illinois. That was supposed to be a facility that could make about 215,000 vehicles. Should be able to do that by now. They're going to make less than 50,000 vehicles this year. So this is not a company that's running on all cylinders as far as operations go. So assume that whatever they're disclosing for an estimated date is probably going to be a best case scenario. And this is where the company's cash position really comes into question. I'm going to walk through exactly how much cash Rivian is burning and why this is becoming a problem for the company. Let's start with Rivian's cash position today, or at least as of the end of the second quarter of 2024, $7.9 billion worth of cash on the balance sheet. That's where I'm going to start this cash walk to show exactly how problematic the cash position is getting for Rivian. And what I'm going to do is I'm going to assume that they're just going to break even on gross profit for vehicles. Basically, they're not going to make any money selling vehicles. Right now, Rivian is losing a significant amount of money on each vehicle it sells from a gross margin perspective. But management has said that they will get to gross profit by the end of this year. That's probably not going to happen given their recent cut in guidance, but let's say that over the next 3 or 4 years, they're basically gross profit break even. I think that's a good baseline with which to start analyzing the company. So let's look at operating costs that are going to be ongoing. Now, Rivian has significant operating costs in part because this is a vertically integrated company. They're developing their vehicle software. They're developing their own motors. They're developing battery technology, autonomous driving technology. They're doing a whole bunch of things themselves. Now, we can question whether or not that's a good strategy, but that is what the strategy is, and that's what the cost structure is built around. So what exactly does that look like today? Based on today's expenses, there are about $2.9 billion in annual operating cash costs. And what I've done is I've taken the $3.8 billion of operating expenses and then subtracted out about $900 million in stock-based compensation. Now, some of that stock-based compensation probably should go into the gross profit line, but we'll give Rivian the benefit of the doubt here and say that the ongoing cash costs from an operating perspective is about $2.9 billion per year. That's probably not going to be able to be cut significantly as they're ramping up new vehicles, designing new vehicles, adding technology, adding autonomous driving. I don't know where exactly you're going to cut $1 billion worth of operating expenses. So I think that's a pretty good bar to get to from an operating cash expense standpoint. The other thing that they're going to have is capital expenditures. Now, capital expenditures over the past 12 months is about $1 billion. I think that's probably a pretty good number from an ongoing basis. There are ongoing capital expenditures costs that go into running a manufacturing plant. So this isn't something that you just build once and set it and forget it for the next 30 years. You've got to continue upgrading your operations. there are expenses that go into that. So I think that's probably a fair number from an ongoing perspective. So you add those two together and you get $3.9 billion worth of ongoing operating cash costs and capital expenditures. On top of that, the cost for the first phase of the Georgia facility is going to be somewhere around $2.5 billion. Most of that expense is probably not going to begin until sometime in 2026. So what I did on this table right here is I showed those costs, that $2.5 billion, split between 2027 and 2028, and just added that to the ongoing cash burn. You round those numbers and you get to about $5 billion per year in total cash expenses in 2027 and 2028. The timing of those may be a little bit different, but in total, those numbers are going to be about accurate. I think this is a good ballpark look at what cash burn looks like. So you add together 2024, rest of the year needs $2 billion, 2025, 3.9, 2027, 2028, you have $5 billion. In total, Rivian needs $17.8 billion worth of cash to get to Q4 2028, when theoretically production would begin at scale in their Georgia facility. They currently have $7.9 billion worth of cash. Now, it's very possible that the second tranche of cash from Volkswagen, which would be about $2 billion, would come into Rivian. But that's not a gift to Rivian. That's going to be converted to stock, and it's going to be converted at the market price. At least that's the terms that we know of today. So that would be just like selling stock on the open market at today's price. That would be dilutive to shareholders. Any other way that you're going to raise money is also going to be dilutive to shareholders if you are selling equity. One thing I did not talk about is the fact that Rivian does have debt on the balance sheet. Current debt on the balance sheet is $5.5 billion. About $1 billion of that is the initial tranche of $1 billion that came from Volkswagen that should convert to equity. So again, shares outstanding are going to increase when that converts. Theoretically, that's going to happen in Q4. That is what management expects. And then some of this debt, about $1.1 billion worth of the debt, is also due in 2026. So that's another refinancing you're going to need. You're going to need to either pay off that debt, refinance it with new debt, or sell equity to pay off the debt. So you have almost $10 billion that you need to just fund operations and get Georgia up and running. Potentially $2 billion of that comes from that deal with Volkswagen, minus about $1 billion in debt that you're going to need to repay. At best, Rivian needs about $9 billion in new capital that we don't have agreements for, just to get to the point where they can open up their Georgia facility. This is the challenge that the company has, and this is what I think Rivian is going to have a really hard time getting past. And the problem is, as the stock price falls, raising capital gets even harder. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. One of the things we see over and over again with these cash burning companies is that once you start this downward spiral, it's really hard to get out of it. And really the only way that Rivian is going to get out of this downward spiral from a cash perspective is to be able to issue stock. That about $5 billion of debt that's on the balance sheet, that's going to make it really hard to raise more debt. And if you don't have a cash flowing business, why in the world would debt holders add to the debt level that's already there, especially at any sort of attractive price at all? So I think assume that debt markets are essentially closed for Rivian right now. So basically their option is to sell more stock. So you have a stock that the current market cap as I'm recording is about $10 billion. But like I said, you need about another $10 billion or so, given round numbers, to be able to get through 2028. How are you going to do that? Well, if you announce a big stock sale right now, the stock is going to drop. But what if the stock keeps dropping? What if it falls 30, 40, 50% by the end of this year? Suddenly it gets more and more expensive every dollar that the stock drops to raise capital to get to the point where you're actually going to be free cash flow positive. This is the downward spiral that companies end up finding themselves in when they don't have a cash flowing business. I think this is fundamentally what Rivian needs to get to. None of this is about whether or not Rivian is making a compelling vehicle. It's about, can they make a compelling vehicle? Can they do it at scale? Can they make a profit off of that vehicle? There is no way that Rivian is going to be free cash flow positive only having their normal Illinois facility. They can't sell 215,000 vehicles and make enough money to cover their operating expenses, to cover the capital costs that it's going to take to build out their next facility. They just don't have the capital or the cash structure to do that. You have to get to scale. This was the challenge that Tesla took years to get to, and luckily for them, capital markets remained open year after year after year. In fact, as new plants were announced, the stock price would go up. The opposite is happening now, which is more normal in capital markets, is that when you announce a big capital raise, typically your stock price goes down. So I think Rivian really finds itself in a challenging position. Earlier in this video, I put all of the numbers on the screen that you need to do all these calculations for yourself. So feel free to go in and adjust them wherever you think is appropriate. But I think no matter how you look at Rivian's business, there are major changes that need to happen to even possibly get to the point where they're going to be able to open their Georgia facility. And even then, I think it's going to be a real challenge. I think it's time for Rivian to start looking at what their alternatives are. Should they just sell the company in its entirety to Volkswagen? I don't know what kind of price they could possibly get for that, but that may be an attractive option. But running the business as it's operating today, given the fact that they are having problems with their own operations, just reduced guidance by almost 10,000 units for this year, almost 20%. That just shows us that this is not a company that's operating well. It has massive cash needs, and as the stock price drops, it looks harder and harder to see a future for this company. But let me know what you think about Rivian's cash position. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.